Welcome everyone to the Trader's Desk. It's the 15th June 2025. Before we get started, this is not financial advice. Everything we discuss is purely for educational basis. I'd encourage you to read the disclaimer. And also, all the materials presented here are the intellectual properties of the Financial Traders Hub. So do read this copyright notice. So, of course, it's been quite um an interesting week, very eventful, dominated by what's been happening in the Middle East. So let's look at how the markets have behaved on the week. The S&P 500 ended up at a negative 0.36%. And a large part of that move happened on Friday, and that was because of all the hostilities or conflicts between Israel and Iran. So we've definitely seen a bit of a risk-off move here, right? As would typically happen whenever geopolitical tensions are on the rise. So, not surprising that energy has been one of the best performing sector. So, if you remember, the oil price had been falling for a number of weeks, and then recently, I think from last week onwards, it started picking up, and that was probably people positioning for a rise in geopolitical tensions in the Middle East. This is a lot more important because it's a lot more important in terms of its impact on the oil price than Israel and Gaza. And the reason for that is because Iran controls a very important stretch in shipping routes, and that's called the Strait of Hormuz. So a large number of oil tankers and refined oil tankers use that route to get their cargoes from all the oil producing countries in the Middle East all the way to all the other destinations in the world. So with the rise in hostilities, one thing is definite: the shipping rates are going to go up because insurance premiums go up, and all the ship owners are a little bit more worried about passing through these routes. And secondly, with how things are getting escalated, Iran could very easily close the Strait of Hormuz, which would be a bit of a problem because that's going to cause a massive disruption in all the shipping routes when it comes to oil and refined oil products. So if that happens, of course, it's going to create a bit of an issue in terms of oil supply, and this is why we've seen the oil price go up quite significantly. Um, and in line with this, energy stocks have risen. So we don't necessarily know how this conflict will progress, whether there's going to be de-escalation or further escalation. I think over the weekend, we've also seen news that the refineries in Iran were targeted by Israel. So that's another factor that could cause oil prices to go much higher because Iran is still a significant producer of oil and oil products. And if their facilities are being impacted, it means that supply from, Iran is going to be cut from the global markets. Even if they're still under sanctions, they still export quite a bit of oil, predominantly to China. Um, and that still counts towards the global oil supply, right? So if China is no longer getting their oil from Iran, they would have to substitute it with oil from somewhere else. It could be from Saudi Arabia or some other oil producing countries. So there's another theme in there, in that China will probably lose access to their cheap oil imports. So if I remember correctly, I think they import close to 15% of their oil from Iran. And if that number is compromised, it means that the cost of oil for China, which is very reliant on oil to power its economy, will go up. And that's coming at a point in time when China is not necessarily doing great economically. So there could be a few trade ideas from that theme in itself. I'll let you use your imagination and figure it out. The other way to also think about it is if shipping rates are going to go up, one could make the case that we should be going long oil tankers, refined oil tankers. Um, of course, it's an industry that's very specialist in nature, one that I'm very familiar with, but the vast majority of members might not necessarily be. So if you're ever uh, thinking of doing anything in that domain, um, please make sure to consult me, and then I'll let you know whether your way of thinking about it is right or not. So I'm just reading your question, Hader. If China needs Iranian oil, would they weigh in on the conflict and deter it? I think they've already done that. They've kind of condemned Israel. But I think, China's stance with any of these conflicts has always been to de-escalate and to try to move to a diplomatic solution. Um, and, of course, China would not, it's not positive for China to have these hostilities whereby, it creates a lot of uncertainties, not just about cost, but also about availability of oil and other imports. So I think that's probably why we've always seen them, being appearing very neutral or even sometimes. I mean, they've always been pro peace, right? At least in their statements when it comes to Middle East conflicts and so on. Um, yeah, so in terms of the trade ideas that you can generate from this theme, it could be something like I'll show you one company that uh, I was looking into. Just bear with me. Thank you. Okay, no problem, Hader. Um, So this is one company that I'm very familiar with. It's called Scorpio Tankers, ticker symbol STNG. So as you can see, the share price has ticked up by 3.7% on Friday. Um, it's not necessarily been in an uptrend in the last few months, and there are very good reasons for this. It's a lot linked to the shipping rates and reduced demand for refined oil products. So what this company does is it only transport clean oil products around the world. So we're not talking of crude oil. We're talking of things like gasoline, diesel, kerosene, jet fuel, and so on. They are called clean tankers, and then the ones that carry crude oil are called dirty tankers. And in between them, it's very hard to switch. So a clean tanker can become a dirty tanker, but a dirty tanker cannot easily become a clean tanker. There's a bit of a let's call it cleaning or s- um, I'm not getting the word, but essentially, once you go dirty, there's a lot of there's a lot of work to do on the ship before you can carry clean cargo again because of contamination issues and so on. Um, so that by virtue of that, it keeps the supply, or yeah, it keeps the global supply of ships in the clean oil products quite tight. Um, and as these hostilities happen, so basically what could happen is you have disruption of shipping routes. What that means is if a lot of cargo is not going through the Middle East because of the conflict, then these ships take longer to get to their destination, which essentially means that there is a reduced availability of free ships to carry, the next cargo. So, as an example, let's say And we've seen this with the recent hostilities in Israel, between Israel and Gaza too, right? Whereby a lot of ships were going around Cape Town, around Africa, rather than going through the Suez Canal, right? So this adds, number like probably 9 to 14 days to the whole trip, and it's a big reduction on the global supply of ships. So, of course, if we find a trade idea that's linked to the escalation in hostilities, we have to be very cognizant that this is a binary event, right? It can worsen or it can significantly de-escalate. And you don't want your trade idea to be on the receiving end if the conflict de-escalates. So, with that said, can we find a trade idea that does not rely on the war continuing and the hostilities just getting worse and worse, but a trade idea that would still work on its own, but gets even better if there is a rise in geopolitical tensions or disruption in shipping routes and so on? I think Scorpio Tanker might be one of them, but of course, do your own work before you get into it. There's a lot to study about the industry and the company before you're able to put a position here. Another idea, which again is this one is going to be a binary one in that your fate will be tied to whatever happens between these two countries. It could be a company like Antero Resources. So they are a major natural gas uh, producer, right? So of course, so a lot of the cargo is from Kuwait. You can always look at maybe it's worth bringing that up, right? Um, Actually, let's do. Sorry, Strait of. Okay, so it's worth looking at this Google map, right? So this is the Strait of Hormuz, right? This is the one, yeah. So we've got uh, we've got Iran here, right? You've got the UAE somewhere here. UAE is here, right? You've got Qatar, Bahrain, Saudi Arabia is here. So you've got few ports in this region here, right? And then you've got Kuwait, that is a major natural oil gas producer and exporter. So all this cargo, right, goes through this Strait of Hormuz and then out from here all the way to, everywhere else in the world. So can you see now why this little stretch of sea is super important? Yeah. And I think if Iran decides to close this, the US will get involved because the US cannot afford another, high inflationary period. This is probably gonna, cause a lot of political chaos and so on. So they have a lot of interest to get involved and to make sure that, this doesn't get blocked, right? Um, so do we all understand the importance of this piece of sea? Okay. Anyone? Any questions? Okay, not really. I think we all get it, right? It's quite intuitive. So, Kuwait is one of the biggest producer of natural gas, right? And you do remember what happened a couple of years ago when Russia, because Europe depended a lot on Russia for its natural oil, right? Natural gas, sorry. And during the hostilities between Russia and Ukraine, Europe decided to switch its supplier of natural gas from Russia to Kuwait and the US. So now, if the cargoes from Kuwait are no longer able to get to Europe, or there is significant disruption, you would expect the price of natural gas to go much higher, and producers of natural gas will definitely benefit, right? And tied to this trade idea, you've also got the rise of AI, which is also requiring a lot of energy demand, right? So this could all work out as one great theme, but also keep in mind that look, the stock was up 4% on Friday, and that's predominantly because of the hostilities. Uh, if there is de-escalation, I would not expect this to sell off a little bit, right? So if you go long the stock now and then there's de-escalation, you might get taken out. You might also, wait for this to pull back a little bit, or if there is de-escalation, then, you decide to look into it to see whether, this company has legs to run further. But this, from my perspective, is a little bit more of a binary type of trade, right? Where if conflicts continue, you win big. But if the conflicts de-escalate, then you probably are, a little bit late to the party here. Okay, any questions on this before I proceed to the next section? Okay, looks like we all get it, right? Um, We've seen a resurgence in healthcare, which is great to see because for the longest time, healthcare has not been performing that great, a large part to do with regulatory changes. So it's good to see capital moving back into healthcare in a risk-off sentiment, right? So if we want to position a little bit defensively in the portfolio, I think getting into healthcare with the idea that it's a defensive sector might start working, right? And there are very, very good companies within this sector that are doing amazing things. And it's not difficult for us with the capabilities that we've got to figure them out and to find a couple of good trade ideas. So the tech sector ended up positive. Actually, that's quite a sign of strength, given that the market altogether was down. So if you remember, tech has been leading this rally for a number of weeks now. And it's not the best performer, but still, in the middle of all this, all of what's happening, tech is still up 0.34% after many, many weeks of outperformance. So that's a sign of strength, right? Utilities are also up. Again, it's a defensive move. It's a risk-off move. Real estate, barely flat, right? And then if we look at the serious underperformers on the week, financials. So what's going on there? Is this just a risk-off move? I think there's a little bit more to that. Financials have been performing really well for the last few weeks, so there could be a little bit of profit taking. Maybe a lot of people who got into financials thinking the deregulation trade is just around the corner. And now they're getting a little bit impatient in terms of, it's clear that Donald Trump has other priorities. He's fighting fires on all fronts, right? The trade deal is not yet concluded with China, although he has publicly come out and said he's won that game. But China hasn't said a word since. So I think the longer the silence goes on, the the more I smell a rat or possibility of a little bit of a surprise from the Chinese camp. So Donald Trump seems to indicate that he's been able to get agreement with China on a 55% import tariff, uh, and he said this is pending the approval of the Chinese president, and we haven't heard anything since. So I don't know what that means, right? This sounds very unilateral to me, but we have to wait and see. We don't want to speculate on things that are of this nature, where it's down to the fickle nature of people, right? and you could easily be invalidated on a tweet. And, that's not an area where we have a lot of influence or even an edge, right? Industrials were down 1.6%. That's quite interesting given that, industrials have been performing relatively well recently. So I don't want to read too much into this, but we do know that recently these ISM reports have not been the strongest. So is it just that the stocks are now catching up to the actual fundamentals? I think there could be a little bit of that happening. But the reshoring theme in the US is what has been propping up industrials. So, we have to keep that in mind. And if indeed the US has been able to secure a 55% import tariffs on Chinese goods, I think that's going to be a big success in the sense that it plays to the manufacturing reshoring theme very well. So I think I discussed it a few weeks ago, whereby I said something along the lines of if the import tariffs are too low, let's say 5-10%, then it doesn't incentivize local manufacturing or manufacturing reshoring, right? Because the 5-10% will easily get adjusted within the foreign currency rates. So there is not much of an incentive for someone to deploy capital and, build a factory from scratch to produce in the US. But if it's indeed 55%, I think the incentive is definitely there. Uh, we're not talking about what this is going to do to inflation at the consumer end, but purely from a manufacturing reshoring theme perspective, I think it's going to add fuel to the fire already. And then I think two things to note. So materials fell in line with industrials, not a surprise there. Consumer discretionary was, I mean, I would probably say that, it's outperformed the S&P. If you look at it purely as one number being bigger than the other. Um, and it's something that we'll look into. So consumer discretionary has been doing quite well. And then on Friday, we also got an updated report on in terms of the survey of consumers by the University of Michigan. So as we've seen, the consumer sentiment surveys have been quite dismal, right? And then, what happened on Friday was that we got an uptick, right? So this is, as the title states, right? This is the first time since December 2024 that we've seen an uptick, right? Uh, is this because people are feeling a bit more positive, especially as we see the tariff debacles, calm down a little bit and things moving along a bit more sanely? I think that's what's happening. Uh, is this an indication that the consumers have seen enough to start opening their wallets and spending? Probably not. But we this is a sign we cannot look beyond, right? It's a very important juncture. It might be a turning point, and typically, you would see turning points when we reach extremes in sentiments, right? So if you look here in 2022, we kind of reached that same extreme as the Fed started going on an interest rate hike, right? We've reached similar levels and now bounced against it. So what we need to look for from here onwards is is this trend going to continue upwards? If so, I think the consumer discretionary segment um, might see a bit of capital rotating into it. Although we have to be careful here because um, consumer discretionary stocks did not really sell off as the consumer sentiment kept going lower. So these companies were still reporting good numbers and their stock prices held up and even went much higher as the data, the fundamental reports were indicating that the consumers are still spending. So Would the consumer discretionary stocks go up in line with the consumer sentiment going up now? It not necessarily, but this is something, you know, that we need to keep watching out for because it's certainly a break in the trend. And as always, right, we can have a long consumer discretionary stock and we can have a short consumer discretionary stock just to be able to get a little bit of a hedge against the whole theme itself, right? So if you pick your stocks correctly, you can still make significant returns. And I think we'll discuss it in the second segment, which will not be on YouTube, but there are lots of opportunities when it comes to these companies and, especially when it comes to turnaround stories. But yeah, that's not for the YouTube channel. We'll keep that for later. Um, Coming back to this, I think I wanted to discuss the industries as well. So, not a surprise here that the oil-related industries have done really, really well. And then we've seen a big sell-off in airlines. So, can anyone tell me why we've seen a big sell-off in airlines?
Oil prices going up, so that
Yep.
increases their cost.
Yeah, absolutely. So airline stocks had been going up in line with oil prices coming down. That's a big input cost for them and a big determinant in terms of, what margins they will be able to achieve. So with oil prices going up, of course, that's a big margin contraction that these companies would feel. We've also started seeing um, Avis, ticker symbol CAR, come down now. So this is a stock that I've been short for quite some time, and basically just okay, this is not what I wanted. So basically, just scratching my head as to why it just kept rallying in my face. Um, and now, for the first time after many weeks, right, we've seen exhaustion signals, right? Um, I'm looking at the weekly chart, right? So you can see, right, this in this week it failed to make like a conclusive new high. The next week saw a little bit of a sell-off, so a lot of profit taking, and then again found it very difficult to make a new high. And then the following week started the week very strong, and then just sold off and quite significantly too, right? So I think as the risk off sentiment takes over, we might start seeing this move down a little bit. So we'll see how this trade plays out. I don't know if I'll get paid on this or not, but we'll see how it goes. This is also a trade that maybe in a different session I'll go through quite in detail because I want to show you how the whole situation unfolded from the time I put the trade on, and then restructuring the trade in between because it was not necessarily working for me. So this goes back to what I said earlier. When we put a position in the book and it's not working, we don't just sit there and pray and wait for things to go in our favor, right? We have to do something with it. Either we say, okay, maybe I'm wrong on the idea, then you take the loss and you move on, or you do something. You don't just sit there and pray and hope that eventually the share price will come meet you in the middle. That doesn't necessarily happen in financial markets. um, I'm quite interested to also see a sell-off in the regional banks. So these have been quite strong. Again, this plays to the deregulation theme that the Trump administration has been alluding that they will look at quite seriously. And this is quite positive for regional banks, right? Because that means more lending, more eventually more profits for these companies. Uh, Home builders, they've not necessarily been the weakest, but they've started to sell off again. um, which is interesting because we can still find opportunities within that space. Um, Agriculture keeps pulling ahead. So this is a sector, this is an industry that doesn't get a lot of mainstream attention, but if it's moving 1-2% per week, that's quite significant because what this means is the individual constituents would be moving a far more than what you see the industry itself moving. So I can promise you within this sector, we would have stocks that are up, let's say 10-15% uh, in the last month. And we can quickly check this. So if we sort this by return, so for instance, this company, CF Industries, it's up nearly 15% in a month. Um, and then you've got companies that are down nearly 15% too, right? So any industry provides you with a wide range of companies that you can definitely find longs and short. It doesn't mean that for every industry we need to find a long and a corresponding short, but if you can, why not, right? So a lot of companies that we've been looking at from December, Nutrien and then Mosaic as well. Not sure if it's part of this ETF. I don't think it is. Uh, or maybe I've missed it. Let me just check. Mm, okay, I don't see it. No, it's not part of the ETF. Um, this is a very quick and easy way for you to figure out what's happening in any industry, what's driving it, and eventually for you to just do a little bit more research and figuring out who are the next winners and losers. And you can do this for any of these industries. Um, I think that's probably all I needed to speak about on in terms of the industries. Let's move on to the corporate bonds. I wanted to see what's happening to this. So basically, what's happening to the spread, to the credit spread on the CCC high yield bonds, right? Last week we looked at it and we said we have to be careful here because we're starting to see a little bit of an uptrend. So this is the market giving us an indication that it's paying attention to everything that's happening and that they believe that the risks are slightly elevated there. It's still not flashing red, no warning signs there. And if you look a little bit deeper into the industry itself, mainly in terms of new offerings. So what I'm talking about is new companies that are raising capital through the corporate bond market, which we would call the primary market. So this is your equivalent of IPOs in the public equity segments. Um, so then the primary markets have been relatively strong or even, quite aggressively priced in the last few weeks. So there is capital for the corporate bond markets. The corporate bond markets are open and, it's quite risk on if you look at the primary market. But, things can always change on a dime. So we have to think about it from this perspective. And the reason we look at these spreads is because as these keep rising, refinancing costs for companies go higher. It also indicates that the risk of bankruptcies within companies is increasing. So the equity markets will typically start paying attention and might start selling off. So we've seen in the past how the corporate spreads going up typically correlates with the VIX index also going up and leading a sell-off in US equities, right? So that's the reason why we look at it. We can even generate trade ideas from this in terms of if we see this rising consistently, we can go find a few companies that need to do refinancing and significant refinancing of their debt because we know that these companies will have a bit of difficulty in securing a good rate. So as the refinancing costs actually work out to be higher, than what the market was expecting, the stock prices could significantly fall. There is a delta, there is uh, an example of a trade that I did probably 4 years ago now. It's a company called Newell Brands, NWL. I think I have shared the trade idea in the Discord server. It's probably well worth your time going through it and understanding how we analyze these types of trade ideas, and how do we find them, how do we analyze them, and how do we figure out that the equity prices might be very sensitive to refinancing risk. Another theme or another trade idea that can be generated from this same theme is along the lines of finding companies that could go into default or bankruptcy situations and then going short these companies. So using Coifin, that's quite easily done in terms of filtering through all the stocks and figuring out which ones have elevated levels of debt and are in industries where maybe margins are getting crushed, revenue growth is slowing down or even going negative, and eventually they might have a lot of problems to be able to service their debt repayments. So these are the ways to generate trade ideas, and you can always find, a very good short trade idea even if you're in a bull market, right? I think Asana is a good example of this, right? We showed it last week, and this week it just crumbled further, right? I think it closed at 13.2, if I remember correctly. So I mean, look at this, right? We went short somewhere here, right? I think I went short here, and then it's now gone all the way down to 13.19. So that's a big move, roughly 30% in the space of 2 weeks. And the market has probably been flat or slightly low, slightly down in the last 2 weeks. And we find a stock that's like underperforming the stock market broadly by, let's say, 28, 30%. um, that's essentially how you generate alpha in your portfolio, and you significantly outperform the markets. Okay, I'm going to pause here and open the floor for any questions that you might have. Hmm, no questions. Okay. So just in case you're a bit curious, so the two themes I just mentioned, one is the refinancing risk, and secondly the default or elevated debt level story. I think this is something we need to take separately in our Discord server and work them out with actual examples, starting from scratch as usual, showing you how we start the whole journey and eventually figuring out a list of potential candidates and then narrowing it down to one or two trade ideas. I think this will be highly beneficial for a lot of the members. And if you don't agree with me, just let me know because uh, I mean, that's what I think. Um, at the end of the day, what I'm trying to impart in the group is that we do not need to be one trick ponies and find trade ideas from one source only. Or let's say there's a war going on, so we go long. That's okay, that's one source of a trade idea. But as a trader who needs to manage 10, 12 positions on the go, right, you need a variety of sources to generate your trade ideas. And this is where I come in, right? Because I can share all these different types of trade ideas with you, how to generate them, where do they come from. And if the sources are independent of each other, it also means that the correlation between the trade ideas would typically be much lower than if you were just, let's say, chasing trade ideas from the ISM reports, right? Does that make sense? Just give me a bit of a feedback. Uh, can I repeat, rephrase? Yeah, sure. So I'm basically saying, Hader, that as a trader, when you're managing a portfolio of 10 to 12 live positions, you need to make sure that there is diversification, right? Diversification doesn't always just mean you have diversity around across industries, sectors, and so on. Diversification also means that you source these trade ideas from totally independent places, right? So if all your trade ideas are probably coming from one report, like the ISM report or the consumer sentiment report, then inherently there's a lot of correlation to one particular theme, right? And that makes your portfolio very vulnerable. As a trader, you need to be able to understand the different trade idea types that are out there, how to find them, and add this to your toolkit so you can always find these trade ideas in all types of market environments, right? As an example, what we did on Asana will work in a bull market, in a bear market. It's going to work even better in a bear market, right? And it doesn't matter what the S&P is doing or what the Nasdaq is doing. Once it's in your toolkit, you'll be able to find similar ideas in the future. So you're kind of equipped for life to be able to find these ideas with relatively high probability. Okay, cool, Haida. Anyone else has any other questions before I move on to something else? Hans, I'm gonna put you on the spot again. If you don't mind, can you run us through the factor analysis?
All right. Roshan, can I ask you one quick question?
Yeah, yeah, go for it, go for it.
Roshan, you mentioned that for the corporate credit, the primary market is being strong, right?
Mhm.
How did you how did you come to that conclusion? Are you what?
Um, there
Where
are
can you get information?
there are a few reports that I look at. What's not helpful is that a lot of this data from the corporate bond markets are not free and publicly available. So, for instance, like equity is very easy to get, price information and all the related information, right? But when it comes to the corporate bond market, because it's more institutionalized, right? There's not a lot of retail traders there. It's very difficult to get access to information in that space. So even when it comes to bond prices, you'd have to bend over backwards and figure out from multiple websites, um, if you don't want to pay for it, of course, right? Um, some of them might have a limit of, you can only search for free tickers and then they block you, right? Or they ask you to go behind the paywall and so on. So um, I think I have a guy, I think it's on Substack. I just need to check. I will share it in the Discord server. He's quite a useful resource to follow in terms of getting an understanding of what's going on in the corporate bond market. But of course, read what he has to say, but don't let it sway you in one way or the other, right? Just take the facts out, but don't take his views or his biases and make it your own. Okay?
Yeah, thank you.
And it's not to do
And
with the guy himself, right? It's how we interpret information from any source, right? We don't borrow the bias and the views of other people. We look at things very independently.
thank you. And sorry,
Okay.
Hans, to keep you waiting.
No problem. I think he's actually quite grateful. uh, I don't know. I mean, I will look for the actual Substack and I'll share it in the Discord server. I'm quite bad with names, so typically these come in my inbox, and then I will kind of read them if I have a bit of time. Um, but yeah, it should be fairly easy to for me to figure out who's that person. Um, Hans, go for it. We kept you waiting for far too long.
Uh, So the picture looks very, very different from last week, almost like 180 degrees turn.
Uh-huh, uh-huh.
It looks very much like risk off this week.
Right.
Last week, I remember we saw a lot of small cap, particularly
Mm-hmm.
small cap growth doing quite well.
Mm-hmm.
Now it looks like capital is moving more into safety,
Yeah.
large cap,
Yeah.
and value.
Yeah. Yeah. Absolutely. So we've discussed this for 3 consecutive weeks now, right?
Yeah,
The last 2 weeks were like capital wanting to go towards growth. Um, I think 2 weeks ago was like large cap growth, right? And now it was looking to broaden a little bit out to the mid cap and small cap segment, but still within growth, right? So basically, moving a little bit further down the risk spectrum, so getting a little bit more risk on, right? And now with the war, it's just gone backwards. So capital moves back into large caps. The value segment does, I mean, it's not done well, but it's kind of flat, right? And then the rest of the segments are just selling off, right? So
yeah.
if you look at the sell-off, right, which ones are the most dominant sell-offs?
Small cap and mid cap growth.
Yeah. So look at mid-cap growths, right?
Yeah,
On a monthly basis, it's just been pitiful, right?
yeah,
And that's predominantly because a lot of people who want to go long risk on would typically choose the mid-cap growth segment. Companies like Asana, C3.ai, this is where they live, right? These
yeah.
companies with high growth profiles, and anyone who wants exposure to these types of earnings profile would typically go into the mid-cap growth segment. These were great, at the start of a bull market and even, in the next few stages after. But as the economy starts, slowing down a little bit, then there is this constant discussion between, oh, but I'm paying this high PE and I'm probably not seeing growth inflecting much further from here. So you see the dilemma, right? And this is basically where investors are like, hold on a minute, I'm not paying 50 times PE. I don't care what the company does or how great the earnings profile look now, but at this stage in the economic cycle, I'm not willing to pay 50, 70 times forward PE. And that's how you see companies that even report great numbers. Maybe they don't raise guidance by as much as investors want them to. And then they just sell off 10, 15, 20% in one day on earnings. Right. So I think, Hans, you will relate to this, right? Because you're like a student of psychology. The market is full of fickle minded people, right? Sometimes you can even say a lot of people with bipolar disorder because one day they feel this way, the next day something's happened, they feel totally different, right? So
Yeah.
in between the two lies the truth. And that's where we have to find our opportunities, right? Companies that have sold off far too much. And now investors might start seeing them as a good buying opportunity. As an example, Lumentum Holdings, after the sell off in July and August 2024, right?
Yeah.
We found that this was an amazing buying opportunity, right? We had done our work before the sell off. And then after the sell off, we realized, cannot believe we're getting this at a much better valuation now. And as the results come through, it goes back to where it was, right?
Mm.
So we have to understand the nature of the beast we're dealing with, right? There's no like judgment here. It's not like this is right, this is wrong. And you'll see this a lot of times with market participants in that they lament a lot, right? Look, the bulls are out here and they're buying mindlessly or whatever, as if, buying stocks is a bad thing to do. It's always a bad thing to do because it's not aligning with your inherent views, right? But the market doesn't really care about your views. And if we adopt this position whereby we always think the market should behave one way and then it doesn't, and we get frustrated and we start cursing the market, we're never going to win, right? When we are wrong, we should first of all accept we are wrong and then take our learnings from there. What is it that I'm not getting? What layer of complication is it that I'm not actually able to peel through, right? What is that extra contextual thing that I'm missing here, right? This is the path of a true student for life. Doing it like a lot of what the other market participants do, especially, if you listen to guys on YouTube, you know, macro people, not to insert a few swear words, but if you listen to these guys, especially the older guys, right? Because they've grown up with the market behaving one way, and over the course of their lives, the market structure has completely changed, right? But these guys haven't yet gotten the memo, and they still think that the market should behave the way it did when they were like 30-year-old. But that's not the case. And they haven't evolved, and they get frustrated because, the market is not aligning with their views. And then, of course, I mean, if they're actually trading, I'm sure they're going to go bust by now because they tend to be more wrong than right. Enough of my renting now. Yeah, so what does it mean for us, Hans, going forward? How can we use this information?
So the way I look at it is will probably be a good time to short some growth companies because capital seems to be moving away from growth into
Mm-hmm.
safe areas. And if we have any kind of good value defensive
Mm-hmm.
idea, this will be great long.
Yep. So I think it was a week or two ago that I said I wanted to find an old economy, low PE slash value long, right? Um, you can see the time is ripe for that,
Yes,
right?
absolutely.
Um, and yeah, sure. I mean, you can still find long growth ideas. You probably need that in your portfolio if you're going to have 10, 12 ideas. But as you can see, the skew is moving a little bit more towards, a little bit more defensive, a little
Yes.
bit more value type, large cap growth. So how do we use this information? If you present me with an idea in the small cap or mid cap growth segment, I might probably ask you, why do we not go for a large cap growth company instead? Not because your idea is wrong, just because the market is not giving any signs that the segment that you've picked from a factor perspective, that this is where capital is moving into. Does that make sense?
Yes, it does.
And you can always argue with me and say, no, look, my company is really, really like an outperformer, an outlier. And if on the basis of just the company, your idea might work, great. You can still put it on. But at the end of the day, we're here to try to stack the odds in our favor, right? So this is where you use this type of information and try to, guess where things might move next and try to align with that.